Edge designations, CFA level 1, pre-reading, financial statement analysis, learning module 7, income taxes. And a few points just to note as we begin this particular pre-read relating to income taxes. Number 1 is this is the income taxes reading related to the pre-reading. As we get to the core materials, there'll be another reading on income taxes. So this is really just, I suppose, exactly what it says, a pre-reading or an introduction of sorts then into income taxes. In addition, also just to note, okay, income taxes, we're really going to be referring predominantly to what we call deferred taxes, taxes that are deferred. We'll talk mostly about that. And then just to note as well over here, we are as per normal. We have all the learning outcome statements for you here related to learning module 7, related to income taxes. Of course, we will repeat all of those as you can see as we turn the page over here. Okay, and turn a page or two, and there we go. We can see the learning objectives there as well. Okay, let's go back a page and let's get ourselves started straight away. Pre-reading a financial statement analysis, learning module 7, which is income taxes. Okay, and just by way of introduction, what we're doing over here, it's quite important just to, we can really summarize most of what we're going to do today in income taxes into really, that's the difference between accounting and taxable income. Because when we look at the concept called accounting income, okay, or what we call accounting profit, what's important to note, where do we get accounting profit from? Who tells us, guys, what is accounting profit to be able to work that one out? Okay, and that we get from IFRS. We've seen that many times before. Perhaps you're on a different system that could be called US GAAP, either one, but that'll tell us what our accounting profit is. There's another completely separate body of laws and rules. Okay, we'll change our color here. And that's called calculating taxable income. Taxable income comes to us from whatever tax authority is prevalent in that particular country. Okay, could be the IRS, whoever it happens to be. We'll call it just the tax authority. Now, the tax authority have got a completely, not completely different, but a different set of laws and rules that they use to arrive at how much tax you need to pay. How much tax you need to pay is called taxable income, versus what the accountants say you need to pay in terms of, not pay, but in terms of what is your accounting profit. Now, as a result of the differences, and just say, for example, okay, your accounting guys say that your income is 100, and it's so important just to be able to understand this. Your tax guys say that your profit is 80. Okay, now, first and foremost, which is your real profit? Well, there's no real or not real profit. Just to understand that for accounting purposes, our profit is 100, and that's what we'll show on our financial statements. But when it comes time to writing out the check, we'll write out the check for the tax man based upon what he says we've got to pay, based on the tax authority. It makes little difference what the accountants say the net profit for the year is. We need to pay our taxes then based on what the tax authority have told us, and that'll be the 80. Okay, so, and that is the key behind what we're doing over here, is that the difference over here is related then going to be to what we actually have to pay for tax, so the tax man says, okay, versus what the accountants say based on their set of rules called IFRS or US GAAP, and they tell us a completely different picture. There we go. Okay, just before we get going, the last point to mention, and we'll go through a nice long example of this as we go through the notes, but just important to notice, and the question must always then be asked, okay, the difference then between these two, between accounting and tax. Well, obviously in our example here we can see it's 20, and we ask ourselves a question, what is that due to? Why is there that difference between accounting, and why is there a difference between tax? And when answering that question, we have to come up and say, well, there's only two possible ways it could be. Number one, it's what we call a temporary difference. In other words, the tax man says you can take your deductions early or you can take the deductions later, resulting in a difference between accounting and taxable income. If that were so, then the difference is purely just of a temporary nature, and if that were so, we would account for it as what we call deferred tax. In other words, the tax is just deferred from one period to a later period due to differences in how we account for things, but the differences is really just going to reverse itself out over time. Okay, then we're going to have a look at, there could be another type of a difference. Okay, and that type of difference is called a permanent difference. That difference, okay, is that as a result of the difference in accounting and taxable income comes about as a result of that they will never match the accounting and taxable income. And why is that? Okay, the reason for that is because the taxman says you will never get a deduction for those particular items. The accounting guys say, yes, that is a very good deduction, and there'll never be an agreement on that. That's called a permanent difference. So throughout our notes, number one to note, guys, that we're going to be looking at the difference between what the accountants say versus what the taxman says. There will be differences. And number two, we need to note the nature of those differences. Are those differences due to just timing differences? Okay, or are those differences then due to or as a result of something more permanent? In other words, the taxman will never allow that amount to be included or deducted, and then that's what we call a permanent difference, and that gets a different type of a treatment. Let's get ourselves going straight away, and there we go. Some definitions just to focus upon as we go. Taxable income, there's a difference between, of course, taxable income, that's the income that is subject to tax, versus taxable payable. Okay, taxes payable is the amount that is subject to tax, the income that's subject to tax, obviously then multiplied by the amount of tax I've got to pay, which is multiplied, let's say, by example, 30%, that's the tax rate, okay, and then I'll pay tax based on that. Okay, and we'll talk about more of the items as we go through the particular set of notes. Let's go on to the next page over here, and we talk about calculate the tax base of a company's assets and liabilities. Now, just to note that as we go through this, there's two very, very distinct ways for us to be able to calculate the tax and what we call the deferred tax. Okay, one of them is based upon looking at a balance sheet. The other one we're going to work through more of an income statement approach, and when asked the question, which one would you do? Well, in a normal setting, you could use whichever one you like. You're going to get to the same answer, of course. They're just two different approaches to get to the same answer. In a question, if you're given it, well, obviously you'll be guided by the information, okay, that you are given in a question. What I want to do is I want to start with number 2 first, okay, and that's what we're going to skip over here, and we're going to come back to this particular section, calculating tax base of assets and liabilities. You can see clearly that then is based more than upon the balance sheet approach, and we will get to that coming up. I'm going to just turn a couple pages, and we'll come back to that in a second. I'm going to go here to page number 5, okay, and we talk about much more from an accounting income statement point of view. And we say, calculate income tax expense, income taxes payable, deferred tax assets and liability, and how that impacts the financial statements. Let's get going. Okay, and as we start this, you'll say, well, what on earth is a deferred tax liability? And then, of course, what is a deferred tax asset? But again, as we go through the set of notes, that will hopefully become clear. I don't expect you to know that's just up front. Okay, and again, we see a lovely concept over here, but again, it's a bit early to introduce it. We will get through it as we go. And that says, when you're accounting income, what is accounting income? That's income as told to you by who, IFRS or US GAAP, is greater than taxable income. I get what's called a deferred tax liability. As I say, guys, I don't expect you to understand that just yet. We will come back to that, and hopefully when we've gone through a nice example, that will become a lot easier and clearer then to understand. Okay, and what I'm going to do is I'm going to work through a nice example from top to bottom, give you all the detail of that, and hopefully then everything then will become quite a bit clearer. Okay, we start off over here. A company purchased an asset for $1 million, 1st of Jan 1907. Okay, now look over here, and as we go through, it's always important to note the differences between accounting and tax. For accounting purposes, we depreciate the asset at 20% per annum. Let's go straight away. So accounting, I've got $1 million asset, 20% per annum. Is everybody comfortable that we depreciate $200,000 every year for a 5-year period? Okay. The tax man comes along and says, no, a tax allowance of 33% is allowed. In other words, you could depreciate this asset across 3 years. $333,000 every year. But what's so important to note is that no matter which method you use, and this is why we call it a temporary difference, or it will lead to deferred tax, reason being is that for accounting purposes, we depreciate how much? $1 million. For tax purposes, we take a deduction of $1 million, exactly the same. What then is the difference between the two? Well, in this case, 2 years, isn't it? As you can see over here, that after the first 3 years till 19.9, okay, for tax purposes, what's the value of my asset? 0. Why? I've written it all off across the first 3 years. For accounting purposes, I still have a value of my asset after 3 years because I've still got another 2 more years to write that asset down. But yes, guys, if we go 2 years further down the line, what would we notice? That no matter which system you used, whether you use an accounting system and provided for depreciation at 20%, or whether you use a tax system and you depreciate it across 3 years, that asset then across a 3-year period or a 5-year period is fully written off. Okay. Now, what do you notice as you come down the page over here? We call this a timing difference. Okay, let's put that over there. Okay. And a timing difference is just the difference due to timing. So, in the first year, what's the difference between depreciation and tax? Everyone comfortable? 133,333. Between 200,000 that I took for depreciation versus the 333 that I took for tax. Cumulatively, that's 133. What happens in year number 2? Well, it's exactly the same. The timing difference, and you see why I call it a timing difference, not a permanent difference. Timing difference is because over time it will reverse itself out. Cumulatively, it now gets to 26666. Year 3, exactly the same thing. I'm now at the end of year 3. Okay, end of year 3, I've got quite a big difference between, well, at least cumulatively, between tax and accounting of 400,000. What happens then as I move forward to year number 4? Well, you notice that difference in accounting and tax goes the other way now by how much? 200,000, because for depreciation, accounting, I take an amount of 200,000. For tax, 0. Okay, that reverses that cumulative difference out a little bit, and in year number 5, again, I take $200,000 for tax for accounting purposes, 0 for tax purposes. After 5 years, all of my differences are reversed back, and I've got a total difference between the two after 5 years then of 0. Is everybody comfortable with that? And you can see that over 5 years, everything has nicely reversed itself out. And the reason for that is because the only difference between accounting and tax was in the timing. Tax said you can have 3 years to write it off. Accounting says take 5. But over 5 years, at the end of the 5 years, well, we're all even and square. Let's see how that looks over here, and just something to note to show you where my numbers are coming from. What we've done is we've assumed pre-tax income as well as taxable income, okay, before depreciation for the 5-year period 1907 to 11 is $2 million. Now we're going to run through the income statement items for you, and let's calculate tax, taxable income, and everything like that. Okay, I'm assuming a tax rate of 30%. How much tax would I pay in the first 3 years, 1907, 8, and 1909? Remember what we said, income before tax, $2 million. Remember what the tax man allowed you. 33333 every year. Is everybody comfortable? Look at the words carefully. Taxable income. My taxes will be based upon what? 16666,667. How much tax do I physically pay then? 1666667 times 30% the tax rate. I pay taxes of $500,000. Okay, those are the first 3 years. What about the next 2 years, 19, 10, and 11, when I've got no more depreciation allowed for deduction? Same story, income tax before depreciation, 2 million. How much tax deduction do I get for depreciation? 0. I wrote it off all in the first 3 years. Okay, and my taxable income then is $2 million. Don't forget to times it by the 30%, and I have to pay taxes of $600,000. That is the tax picture. Let's look at the accounting picture. The accounting picture says, well, what is your income statement for 19, 7, 8, and 9? And it's $2 million. Same thing for tax. But remember, for depreciation, all I was allowed was $200,000, not 33333. The accountants say that my income is 1.8 million. Okay, now we do it. Let's just do the next 2 years as well. I'll come back over here. The next 2 years is exactly the same, isn't it? Because remember, we're writing off depreciation across 5 years. So there's my $2 million income tax, income before depreciation. There is my depreciation charge of $200,000, pre-tax income of 1.8 million. Same story. Nothing changes in accounting for 5 years because the numbers are exactly the same. What I want to show you now, okay, we've got all of our numbers that we need. Okay. Now, actual taxes, and remember, the amount of tax that you pay is always going to be based upon your tax calculation. My tax calculation I've done, guys. My taxable income was 16666. Based on that, I times that by 30%, and I'm just going to put it over here in big, because there often leads to confusion. Okay, right, in a nice and red. Taxes that I've actually paid are 500,000 in years 1 to 3, and in years 4 to 5 we see the amount went up to 600,000. Okay, and where did I get that from? There's my 500,000 there, there's my 600,000 there. Physically, I write out a check to the receiver, or to whoever it happens to be, the IRS, the tax man, and that check is equal to the amounts we've shown you over here. In year 1 to 3 and year 4 to 5, you can see the amounts are different. Reason being is because my depreciation charge for tax is different in those two different periods. Finished. Let's go and look at, now what we do is we say, well, hold on a second, hold on 1 second. Let's, and this is where it just gets a little bit interesting. Let's go and look at this then from an accounting point of view. Okay. Ignore the tax calc for just a second and say, well, what if I was looking at this purely from an accounting point of view? Okay. Purely from an accounting point of view, what would I have said? I would have said, hold on a second. In the first 3 years at least, we'll start off with these. I had pre-tax income of 1.8 million because my depreciation deduction was only $200,000. Okay, if I had to pay tax, we know we don't, but if I had to pay tax based upon accounting income, what would I pay? So I take my tax expense. Okay, it's going to be 1.8 million, which is my pre-tax income at 30%. Okay, and that equals to 540,000. And now this is the whole crux, guys. And this is, guys, for years 1 to 3. This is the crux. What we now say is that the accountants say you should have paid tax. Listen to the words. You should have paid tax based on 540,000. Okay. Because that's what we say your income is. The tax man says, no, no, no. I only want 500,000 from you. The accountants say, yeah, I want 540 from you. What's the difference in the first 3 years? In the first 3 years, the difference will be $40,000 for years 1 through till 3. Okay. Now the question is that a deferred, so, and all that we're saying is that that is tax. Eventually it's all going to wipe itself out because the depreciation charge reverses out across 5 years. So yes, that'll reverse itself out over time. But the question is, at this point in time, as we stand now, at the end of year 1, I've got a difference between tax, where I physically pay $500,000, and accounting, where I think I should have paid a little bit more. You know what that 40,000 difference is? Well, that is deferred tax. That's tax that's just deferred. Why? Because in the next couple of years, when my depreciation charge becomes less for tax purposes, and he gives me less of a deduction, in fact, he gives me 0 deduction in year 4 and 5, what then will happen? Oh, well, then I'm going to have to pay more tax, as you can see. Then my tax goes from $500,000 in the first 3 years to $600,000 in years 4 and 5. Why is that? Well, that's because in year 4 and 5 I don't get any deduction, because I've already taken all of the tax depreciation in years 1 and 3. So in year 4 and 5, what's going to happen? I'll pay more tax then. What happens in year 1, 2, 3? I'm going to be paying, I'm going to get rid of this. Okay. What happens then, guys, in years 1 to 3? I pay less tax or too little tax. Year 4 to 5, I'm going to catch that up, don't worry, and I'll pay more tax. But in the first years, 1 to 3, when I'm paying too little tax, I will pay more later on. So this $40,000 that we've got over here, we call that a deferred tax liability. Why liability? Because I'm going to have to pay that $40,000 more of tax in years 4 and 5, so I provide for it now. Okay, and then in year 2, same story, difference being 40,000. Year 3, also 40,000. So what do you notice then, as we come then to the end of my 3 years, I'm providing 40,000 deferred tax liability every year for 3 years, years 1 to 3. Okay, each one's going to be a deferred tax, and it is a liability. Why liability? Because I'm paying too little tax now. Well, I'm not paying I'm paying the right amount of tax that the tax man tells me. But according to accounting, I should be paying 540. I'm only paying 500. I raise a deferred tax liability in years 1, years 2, and year 3. Everybody comfortable that by the end of year 3, I now have a deferred tax liability of $120,000. Let's go and see what happens then, guys, in years 4 and 5. Well, let's go again. Now, what did the tax man say? Well, according to the tax, how much tax did I pay? We showed you that. $600,000 for year 4 and 5. Accounting, what did the accountant say? The accountant said, well, okay, you need to pay how much? Same story, didn't change for the first 3 years. You only need to pay $540,000. Why? $2 million. Remember, for accounting purpose, we are still taking a bit of a depreciation charge of $200,000. So for the accounting guys, the difference over there is the tax that I should pay, even in year 4 and 5, doesn't change. It's still 1.8 million times the tax rate of 30% by 540. So now I'm paying too much tax, at least according to the accounting guys. I should only pay 540. I end up paying 600. How much am I paying too much of? 60,000. Okay, what is that? Well, it's just deferred, isn't it? And now what is that? That's going to be a deferred tax. That's now an asset. In year 4, what about year 5? Exactly the same thing, a deferred tax asset. Total deferred tax assets then for year 4 and 5 are 120,000. What was my liability closing? Let's go back a page. My closing liability at the end of year 3 was 120, a liability of 120, and an asset of 120. At the end of year number 5, what's it equal to? 0. Deferred tax balance on my balance sheet is equal to 0. And why is that? Because over the 5 years, everything reverses itself out. Why does it reverse itself out? Because for both accounting purposes and tax purposes, the full amount was allowed for depreciation, just different rates were allowed in different years. The accountants wanted 20% per year. The taxman said, no, I want 33.3% every year, but over 5 years. You can see over here, we've shown you that nice and clearly. Everything then reverses itself out. Okay, down to 0. Okay, let's go back. What do we notice? To notice then, if I take you all the way back over here, that in our case, when my accounting income is greater than my taxable income, let's just make sure we see that. In the very first couple of years, my accounting income was how much? It's just got a dark purple over here. My accounting income in the first 3 years was, can't see that so nicely, let's just clean that up. So in my accounting income in the first 3 years, 1.8 million. My taxable income in the first 3 years, okay, let's just clean that up, was how much? 1.6. So you can see that my accounting income was 1.8, which is greater than my taxable income, which was 1,666,667. And what did that give me in my first 3 years? A deferred tax liability. If I take you back over here, okay, we can see that nice and clearly. When my taxable income is less than my accounting income, I get a deferred tax liability. Yes, of course, in year 4 and 5, we saw that reverse itself out. I'm not going to spend too much time over here because it's just a carbon copy in reverse, okay? But we go through the whole example for you again, okay? Just reverse the picture, okay? If the concept is very clear to you, I wouldn't spend too much more time here. If not, maybe just to have a good look at it again and redo some of these examples. But look what we've got over here. When do you get a deferred tax asset? Okay, well, you're going to get a deferred tax asset when taxable income is greater than accounting income. Deferred tax asset. And look at the example now that we've used, and we've reversed the whole picture for you. Okay, accounting income 33%, in other words, we write that off across 3 years, and tax gives you 20% per year. Again, why do we talk about deferred tax, deferred tax, deferred tax? Reason being is the differences are only due to timing, but have a look over here. Both parties would allow you the full amount then of tax to be provided for. Okay, and that's over there. Everything's over there. You can do the example again if you so choose. That'll give you a full picture again. Okay, if you're battling with that. Okay, I wouldn't spend too much more time over there, but there we go. Okay, what I want to do now. Okay, there's another example for you there on page 8. I've given just another example. Okay, I'll just read it through for you just to show you the differences. Okay, and look at it, just to note, it's deferred tax. The company makes a provision of $1 million per year for the first 2 years. So just have a quick look for accounting purposes. Yes, I can take those 2 years worth of warranty provisions totaling $2 million. Okay. And for tax purposes, the 2 million was used up only in 2014, so that's when he gave you that tax deduction. But all in all, guys, $2 million was taken for both parties, okay, both for accounting, but accounting took it across 2 years, tax took it across 1 year only, but the total amount of $2 million warranty provision was allowed for both parties, just the difference being due to timing, okay, and obviously that'll reverse itself over time, but that does create what we call deferred tax in the meantime. And then you can see over there are your differences. Okay, just do take a look at that. This just takes it from the other point of view, okay, in terms of a deferred tax asset, okay, but a carbon copy of what we've seen already. As I say, if something that you are battling with, perhaps go through it, but if not, it's just a reversal of what we saw already, a little bit of duplication. Okay, and that is, guys, that is the whole of deferred tax, by the way, when we look at it from the point of view then of the income statement. Okay, just a quick summary, guys. What we say is that the deferred tax comes about as a result of timing differences between the treatment of items between the accounting people and the tax people. But if that difference will reverse itself out over time, that's called a temporary timing difference, deferred tax. And whether it's an asset or liability, well, we say which way does it go, and we've got our rules as we've shown you there. But that's looking at it from an income statement point of view. We could also look at it, guys, from the point of view of a balance sheet. Okay, in other words, we look at what is the balance sheet balances between the two items, between which two items. Now look very carefully, between what we call, what do the accountants call their balance sheet items? It's always called, guys, a carrying value. Okay, what does the tax man call their items on their balance sheet? If they had a balance sheet, what would they call theirs? Well, they call that the tax base. Okay, now when you're looking to compute the difference between for deferred tax and the timing differences, what do? We always just compare what? We compare the carrying value. And remember, guys, carrying value is always going to be the accounting term that we use to see what the balance on your balance sheet is. For taxes and the tax man, he will always use the term tax base. Okay, and let's go back to our original example, and let's have a look after the first year. Remembering again, the tax man allowed us how much? 33 1/3% off every single year, and the accountants took 20%. If that were so, what is the value then of our assets at the end of the first year? Well, for accounting, I started off with $1 million. Remember, I took 20%, so I depreciated by $200,000. What's my carrying value? $800,000. When I look at it from the tax man, he also started with $1 million, but he gave me 33 1/3%. What's his tax, what we call tax base? 666,667. Okay, if I then have to say, well, what's the difference between the two of those? Okay, it'll equal to 133,333. That's the difference in the total values. Don't forget to tax that, times that by the tax rate. Okay, and what do you get to over there? Exactly the same 40,000 deferred tax liability that we had when we did the income statement approach. So the two approaches are carbon copy, guys, in their results. When looking at it from a balance sheet point of view, we look at the carrying value per the accounting guys versus the tax base for the tax man. And again, if I take you over the page, what's going to happen over time? It'll just reverse itself out. Okay, top of page 4, what we give you is just a couple of differences over here. Then when we look at the differences between tax base and carrying value. Okay, what about dividends receivable of $2 million? Okay, in the books of the accountants, it's an asset because I'm going to receive a dividend in the future. For the tax man, they are not taxable. Therefore, the tax base and the carrying value are exactly the same thing. Okay, let's look at accounts receivable. This is an interesting one. Okay, for accounts receivable, I've got what we call a doubtful debt provision. Okay, or I think about $1 million worth of my 5 million are going to go bad. Okay, so for accounting purposes, what I do, I say, well, I've got $5 million worth of accounts receivable. I think $1 million will go sour. My carrying value, my asset, is then sitting at $4 million. What would the tax man say? No, he says, tax purposes, no provisions allowed until there is actually a bad debt in place. So he keeps the value at 5 million. We keep the value at 4 million. The difference of $1 million, of course, is just due to timing differences until we're assuming those bad debts then do go bad. They'll reverse itself out. But in the meantime, the difference in the 5 million tax base, that's what the tax man says the asset is worth, versus the 4 million, which is what the accountants say the asset is worth, will result in deferred tax. Okay. And we've given you a little bit of there's just those examples for you then on the liability side. Okay. And if you do take a look over here, okay, these are your general rules. When your asset on the carrying side, the carrying amount or carrying value is greater than the tax base, deferred tax liability. When your asset is less than the tax base, it's a deferred tax asset. And then we look at it also from the points of view of liabilities. When your carrying amount of your liability, remember carrying amount, carrying value, same thing, okay, is greater than the tax base, deferred tax asset, and deferred tax liability the other way around. Okay, so remember, coming out of this particular section, what have we seen thus far? All we really need to keep in mind is that when the difference comes about as a result of timing, but over time it'll be exactly the same thing, we get deferred tax. Two different ways to do it. You can do it from the income statement, which we've shown you the first method, or from the balance sheet, when you then compare the carrying values of assets and liabilities to their tax bases. Let's turn a couple of pages now because we've seen all of this already. Okay, and there on the bottom of this particular page was your deferred tax asset example. Let's turn some pages. Okay, let's go, and we're turning. Let's go over here. Okay, what we do now is what happens if there is a change in the tax rate. In other words, that the tax rate, and let's just look at it by example, the tax rate used to be 40%, and very kindly the tax man reduced the tax rate to 35%. Okay. Remember, the deferred tax assets or liabilities, whatever they happen to be, when they now go and sit on my balance sheet, that $1 million, remember that $1 million has already been multiplied by the tax rate to get to what the deferred tax liability is, or the deferred tax asset. Now, so that $1 million worth of deferred tax that sits on my balance sheet, we ask ourselves the question, where did it come from? Well, it was $1 million, that's the actual liability, but the tax rate at that time was 40%, so it would have been based upon what? Timing differences of 2.5 million. And what would I have said? I said, okay, my timing differences between accounting income and taxable income is 2.5 million, times that then by the tax rate of 40% that was in play at the time, and giving me a deferred tax liability then of my $1 million. Now when the tax rate changes to 35%, what I need to do, I need to go and take that $1 million, gross it back up at the rate that it was created at, and now multiply it by the new rate of 35%. And what do you notice? That my deferred tax liability goes down. But of course it goes down because it's now based on a lower rate. And there's your 875. Okay, and in fact what's interesting is that as my liability goes down, we need to reduce it then from $1 million to 875. We in fact create a little bit of income over there of $125,000, and we say thank you to the tax man for giving us that tax break. When it goes the other way around, guys, top of page 11, when the rate goes from 40 to 45%, same story. You take your tax liability of $1 million, you gross it back up to reflect what it would be in terms of timing differences. It would have been 2.5 million. And now you times it by its new rate of 45%. Okay, there we go. And the deferred tax liability now has gone up. And of course it has, because so is the tax rate. And by $125,000, and now that becomes a reduction in income. I debit my income statement. In fact, it's a bit of an expense now for me, and of an additional $125,000. Same thing would apply, of course, to deferred tax assets and liabilities. Okay, when the tax rate moves around, to take a look at those. Okay. Top of page 12, it's a bit of a strange place to put this, but this is where they come in the set of notes, okay, is temporary differences. Well, temporary difference we've dealt with in detail. I'm not going to spend more time over there. But remember what we said? We said that the difference between tax and accounting income can come from only really one of two sources. The difference could be temporary nature, which would create deferred tax liabilities or deferred tax assets, depending on which way it goes. or they could be permanent in nature. If they are permanent in nature, well, then they'll never reverse itself out, and then there is no deferred tax, because the difference will never, it's not due to timing or temporary differences, it is permanent in nature. Okay, and we'll look at a bit of an example of that in a second, but what we do over here, it's a very often used calculation. Okay, it's called the effective tax rate. The effective tax rate says, what per my denominator, what was your pre-tax income? Okay, and then per the income statement, what was your income tax expense? Now, if this answer, the effective tax rate, is anything different to what the normal tax rate is, what the statutory rate is, then we say, okay, quite clearly we have had permanent differences. And let's do an example of this. Okay. And hopefully that'll clear it up. A company pays life insurance to the value of $1 million. Okay, over the page. Okay, and what do we know about officers' life insurance? For the tax man, taxable income, no deduction. For municipal interest, if you invest yourself, guys, in a municipal bond, sorry, I just missed one over there, let's just go back. Okay, the company owns a municipal bond, etc., etc. Okay, and we'll look at the amounts over here. Remembering, guys, and that's why guys often invest in municipal bonds, because the coupon interest, in our case over here, is tax-free. So you can see over here, your municipal coupon interest, it's not taxable over there. So we started off with a profit of $1 million for tax. We started off with $1 million of profit for accounting. But look at the differences. For accounting, I do take life insurance into account. The taxman will never give it to me. What's that called? A permanent timing difference. Municipal coupon interest, then what happens, guys? $2 million. I say for accounting, yes, it's income. For tax, no, he doesn't say it's taxable. You can get off scot-free for that. But that's permanent. That's never going to be the same for accounting and tax. It's always different. It's what we call a permanent timing difference. As a result, my profit before tax, for tax, is $1 million at 40%. I physically write out a check to the receiver or to the IRS, whatever it happens to be, of $400,000. For accounting purpose, look at this massive difference. I say my profit before tax is $2.5 million. But we know what the tax is, don't we? The tax is $400,000. We've calculated that already there. My profit after tax, therefore, is $2.1 million. Let's go and have a look at the differences now. So let's calculate my effective tax rate. My effective tax rate, what was my tax? $400,000. What did I say for accounting purposes? Profit before tax, 2.5 million. What's my effective rate? Only 16%. Now, ask yourself the question, why is the statutory tax rate 40%, but my effective rate is so low? I'm only paying tax at 16%. Well, the big difference, of course, guys, was that there's a massive amount of income called municipal coupon interest of $2 million that was not taxed. And that obviously then reduced the overall tax rate from what? From 40% down to an effective rate of 16%, and that's of course why people choose municipal bonds. Okay, another concept we move on over here, guys, which is called the valuation allowance. The valuation allowance is an allowance that we have to look at and you say, when I create myself what's called a deferred tax asset, okay, remember, if it's deferred tax, what's going to happen? It's going to reverse itself out over time. But now when we talk about a deferred tax asset, okay, then I've got to make sure that in the future there's going to be what we call sufficient future taxable income that I can recover this deferred tax asset. Because yes, I've recorded it as an asset in my books at the moment, but it'll only be recognized as an asset and be able to be realized as an asset if what happens, if I've got taxable income in the future. If I don't have taxable income in the future, well then I've got to reduce my deferred tax asset by what we call a valuation allowance. And the valuation allowance just takes the deferred tax asset, reduces it somewhat by saying what? we're not so sure that there's going to be enough taxable income in the future to be able to realize this deferred tax asset. Okay. In terms of US GAAP, if there's a 50% chance or more of the deferred tax asset not being recovered, we then reduce that by the asset by what we call a valuation allowance. And there we go. Okay. And the valuation allowance is really, it's a contra account, it's a reduction account to a deferred tax asset. And if things change, yes, we can write the deferred tax asset back up. Okay. We look over here, guys, what needs to be recognized in terms of taxation items in the income statement and balance sheet. Okay, some interesting notes we put over here. Deferred tax assets and liabilities never get discounted back to their present values. Income tax and deferred tax are recognized in the income statement, unless, of course, they relate specifically to an equity item, which then we can take them directly then through to equity. When there's any change in the measurement of assets and liabilities, could be as a result of changes in tax rates. I need to reassess, is my deferred tax asset recoverable? And changes in expectations, how assets will be recovered. We need to disclose all of that. That then brings us to a conclusion of income tax. I'm never really sure why they're called Learning Module 7 income taxes. I normally refer to it as the deferred tax section, because essentially, as you note, we've done many different deferred tax calculations. And just again to conclude, guys, deferred tax comes about as a result of timing differences, which are temporary in nature but will reverse itself out over time. Two different ways to do that: an income statement approach and a balance sheet approach. Okay, and when you look at both of those different approaches, we'll give you exactly the same answers. Part of your job is then to determine, is it a deferred tax asset or a liability? And there's a bit of a summary for you then on page 15 and 16. Do take a look over there. As per normal, I always ask everybody to go back to the beginning then of the set of notes, learning module, okay, number 7. And just take a look again at the learning outcome statements and make sure you're familiar with them. For example, if I say to you, could you calculate the tax base of a company's assets and liabilities? Could you calculate income tax expenses? What happens when there's a rate change? Things like that, just to make sure you are familiar then with those. This then brings us to a conclusion of Learning Module 7, Income Taxes.